Good morning, ladies and gents, and welcome to the July 2025 edition of the Blackfinch Asset Management 10-Minute Market Forecast. My name is Jordan Kent, Distribution and Sales Exec for Blackfinch Asset Management, and I'm joined today by Josh Clayton, Listed Product Specialist. For those new to our webinar, we take this time to cover important events that have occurred over the last month, as well as highlighting events that are on the horizon that we feel is especially important to look out for, providing you with the information you need to answer clients your questions have. If you have questions during the presentation today, please feel free to submit them using the Q&A box at the bottom of your screens, where we'll come back to you once the broadcast is finished. Otherwise, we'll provide you with our contact details at the end of this webinar to reach us directly. Before we begin, it's important for us to note that the details covered in this webinar are intended for the financial professional community, and that the details covered should not be taken as financial advice. So we've got three things we're looking to cover for you in today's edition. First, we'll be exploring what effect a weakening US dollar has on the UK investors' returns, where despite US returns showing signs of recovery, a weaker dollar has reduced returns when converted back to sterling. Next, we'll be looking at year-to-date performance, and the theme is still America first, or if things have changed. To many analysts' surprise, the S&P 500 has hit new highs, but that doesn't necessarily mean the top performance tables in 2025 so far. And so we'll look at how this strengthens the case for broader global diversification. And finally, we'll consider what's next for US economy and what this could mean for our portfolios. We'll unpack the political and economic forces shaping the US outlook, such as tariffs, immigration policy, and labor market pressures, and how these factors can influence inflation and interest rates, creating both risk and opportunity for diversified portfolios. So with that said, I'll hand over to Josh to get into the thickets. Josh, good morning.
Good morning, Jordan, and to all of you tuning in. So Jordan's very nicely summarised our three key themes heading into July, and I want to expand on these and how they may play out over Q3. And I'm sure, as you know, today marks the official first day of the third quarter of 2025, and I think we can all agree the second quarter was just eventful as the first, and I wouldn't be surprised to see sustained volatility in markets for the third too. But first, if we explore this first bullet point and what's been happening in the US market and also wider currency markets. So in the US, corporate America has been very robust, with the S&P 500 growing earnings by 7.6% year on year to last quarter end. And as the US begins its Independence Day week, the index itself is back at an all-time high. So this chart shows normalized data as of the 19th of Feb, which was that highest level before the recent drawdown. And it explores the fortunes of investors that have invested into the S&P 500 through different currencies like your dollar, the yen, sterling, and gold. And a caveat on gold, this is a bit of an outlier in this example due to its sheer appreciation over recent years, as it's been that safe haven asset during this volatility. But if we look at the emerging trend on the chart and bear in mind, all investors are buying the exact same companies, the same valuation, the weighting in the index over the period, we have very different fortunes. So if you're a domestic investor buying the S&P with American dollars, then you would be relatively happy as you've recouped the losses since the drawdown, but the likes of us in the UK doing the same will still unfortunately be sat in the red. And there are a lot of reasons behind this, with the main being the depreciation of the dollar against these other currencies. So I guess we ask, why is the dollar depreciating given that US rates have been in a state of higher for longer? And this kind of comes twofold. One is from the expectation of the forward path of interest rates between developed central banks. And then two, it's that the US jobs market is showing signs of trouble ahead. And Trump has turned his attention to immigration. And in doing so, he's caused significant unrest across the country. And this reduced immigration on the back of a tight jobs market risk sparking inflation. And this is something that may make the Fed maintain its current level of base rate. And when it comes to interest rates, the problem for the dollar has been that the currency's weakened as banks like the ECB have cut rates when the Fed's held steady. And usually a widening interest rate differential acts like a magnet. It draws investors and their money toward the higher yielding currency, causing it to appreciate relative to others. And a weakening dollar under this circumstances has been a bit unusual, and even more so as it's known as the world's reserve currency and arguably the number one safe haven asset. But the dollar's weakening, as US rates are high, and that means UK investors owning US assets are going to suffer from currency losses. And essentially, they have to convert sterling into dollars to buy any US financial asset. And in doing so, investors gain exposure to that underlying asset and then the dollar. Hence, when the dollar falls, so does the value of the portfolio, all else being equal. And that's what I want to draw your attention to on the chart here. It's that difference between the grey line and the blue line, which talks to the differing fortunes. But therefore, diversification remains the core theme of 25 as uncertainty emanates from the US. And if we play more on that theme of diversification and try to understand what's happened since the turn of the year, we've again normalized the data over the same period, taking the S&P 500 and the MSCI All World excluding the US. And that just gives you a bit of a barometer for the rest of the world's market performance. And as we can see, the rest of the world's stocks have beaten the US by about 10 percentage points since then, excluding the impact of Forex. So even though this is a new all-time high in the S&P 500, sadly, it doesn't change the narrative that it's best to take money out of the US and reallocate elsewhere. And I know that we've talked a lot about the Mag 7 over the years, but it's worth pointing out that this rebound has little to do with these giant tech platforms. If you use an index where its constituents are only the Mag 7, you'll actually see that their performance is in line with the other 493 stocks. And I really want to reinforce here that the state of play for global markets has changed. We had such a long period of rock bottom interest rates, US market dominance, and a general underperformance from other developed peers. But as we've explored over recent webinars, that diversification element can really help your investors, one, shelter themselves from any further systematic events like political uncertainty, and two, gain access to companies with improving earnings overseas, particularly from the likes of Europe and emerging markets. But you can argue the sell America trade has been overdone, and you need to kind of look past the noise from the media. I was having a quick look at a Bloomberg analyst year-end forecasts, and they've just started to raise their estimates for US companies after slashing them during this trade fiasco, and that does raise optimistic momentum as they're engaged and up in their forecasts again. And it still shows that the US does and should command a respectable allocation in a portfolio. The US market as a whole is over 25 has been dominated by politics. I think the realization that Trump 2.0 was very serious about tariffs, followed by a complete shock after the extreme levies announced on Liberation Day. And it's worth remembering that this 90-day pause that triggered the rebound ends next week, and it is still unclear on what the administration will do. But the recent rebound largely reflects the belief that the big Liberation Day tariffs will quietly go away for the most part, and that the levies already in place won't hurt the economy or company bottom lines too much. And after a few good weeks to the administration, the hope is that Trump's going to stop from these market unfriendly ideas and just go full bore on tax cuts and deregulation. Finally, I wanted to touch on the US economy and the theme of hard versus soft economic data that our CIO, Dan Appleby, and I have been building on recently. So Trump's campaign was very clear in that he was going to use tariffs and clamp down on illegal immigration. And the US appear very frustrated with this stubborn inflation, immigration pressures, and he was brought largely in to fix these issues. And I've touched on tariffs. If we focus on immigration before going into the chart, I'm sure many of you know Trump launched what he called the largest mass deportation program in history, focusing on cities like LA, New York, and Chicago. And it's led to widespread ICE raids, and it's sparked nationwide protests. And while border crossings have gone to historic lows, I think they were down 93.5% in April compared to the previous year. But these aggressive deportation tactics are suggesting that there could be labor shortages emerging in key industries like agriculture or hospitality. And if that continues, a supply shock to the jobs market could lead to rising inflation in the near term and over the coming months due to higher wages being passed on to consumers. So just using the chart here and starting with the good, which includes hard data, meaning actual recorded economic activity. For all the talk of tariffs and turmoil, The recent inflation print undershot expectations. It was printed at 2.8% instead of 2.9%. But that is just one point in time. I think what's more pressing now is a potential for a labour shortage, given this mass deportation program's underway. And it comes at a time when the jobs data in the US has cooled significantly from what was a very hot market after the pandemic. And if this program does begin to stoke inflation from the supply side of the labour market, Trump may be forced to relax his anti-immigration agenda. But for now, it's evident that tariffs are going to persist in some form, regardless of how many trade agreements are signed. Businesses have been almost frozen into inaction until the situation stabilizes. That potentially leads to deflation over the longer term as hiring slows and investment slows as well. But we need to kind of understand, is Trump's immigration bark going to be worse than his bite? And then that can kind of feed through to further deflationary pressure on the job market over the longer term. But ultimately, it's going to force the Fed to manage and balance the effects of these unpredictable policies and actions. So a final summary, the US dollar has been a drag to performance for those investing with sterling, and it could continue to be the case with current policy stances from Trump and the Fed. As we've touched on before, we favour regional diversification relative to peers, with an overweight to Europe and emerging markets for our MPS portfolios. And we believe diversification will remain the key theme to unlocking returns over 2025. And finally, the jobs market is one of the key factors to consider when it comes to policy action by both Trump and the Fed. We are starting to see some cracks emerge, and this can open investors up to downside risks if they're not correctly allocated. I think now we look forward to Trump's decision on the 90-day tariff pause, and I think we'll go from there. But that's all from me, Jordan. I'll hand back to you for wrap up. Thank you.
Thank you very much, Josh. And thank you, everyone, for joining us today. We hope you found all this content useful. As promised, on screen now, we've got details to contact us directly if you've got any questions on the content we've covered, or perhaps you have questions on elements we didn't cover. So please do reach out. So we'd love to hear from you, and we'll take the time to come back. That concludes today's broadcast. You can join us again for our next installment, which will take place on the 5th of August at the same time of 8:50 a.m. But for now, from all of us at Blackfinch, we have a positive start to third quarter, and we look forward to speaking with you again very soon. Bye for now.